Well, as Art mentioned, my name's Gera McGuire, not Jerry McGuire. If you call me that, I'm going to ask you to show me the money. So just know, in a pension room, that should still be funny. I'm Gera McGuire. I'm a senior vice president at Moody's Investor Service. We have a Dallas office. We have about 25 or so analysts at the Moody's office, and we do local government credit ratings. So whatever's happening in the pension plans is affecting the credit rating and the outcome, and then therefore what the city's going to pay in capital costs. I guess I should thank Art and Alan for having us today, and then also just you for staying on the last day and showing up to a Moody's event, a Moody's panel. So, okay, I have a couple numbers and whatnot, so I'm just going to kind of use my notes to go through that. But we have, at Moody's, we have an actuarial on staff, and he's our pension expert. He actually lives in Texas now, but he had a schedule conflict and couldn't be here. So, you know, if anybody is interested in speaking with him on, you know, details or anything to that effect, we are more than happy to connect you with him as well. But I'm basically going to provide you with a broad overview of how the ratings are impacted by the pension figures and how Moody's calculates those pension figures. We don't take the reported pension figures, we actually adjust them. And then Grayson's going to give you a little detail about the trends in Texas and so on and so forth. So we want you to get the most out of this session, and I know I personally do better interactive, but it's the third day, so I'm sure nobody wants to jump in. We are in person, though, if you want to. So is there anybody that really was like, oh gosh, I hope Moody's talks about XYZ, or had a question for us that you want to throw out there so we can make sure we address it? Yeah?
Yes. The question is, what's the correlation between the soundness of the pension system to the plan's sponsor rating, and how does it impact the Moody rating of the municipal bond, and how can they improve it?
Okay. So let me make sure I understand. It's how does the pension affect the rating? Okay. So the actual scorecard that Moody's uses in our methodology, so there's a methodology for cities and counties, and then there's a methodology for K12 districts. They're separate, and the calculations are separate. But in the city and county methodology, 10% of the overall scorecard outcome is based on the pension figures. That does not mean that that is 10% of the rating outcome, because at Moody's, the scorecard indicated outcome is only the actual rating outcome about 30% of the time. So I know that's a lot of numbers, but essentially what happens is if your pensions are mainstream, you're within the medians and what we're observing, you know, it's likely to factor in about 10% of the time. Anytime they get outsized, better or worse, in most cases it's worse than peers, we start to put a lot more value on the pressure that that pension is going to put on the rating. And there's several reasons for that, and I'll go into a little more details but with numbers, but just to kind of answer your question, we adjust the net pension liability. So your actuarial puts together your report, let's just say it's on 12/31, and Moody's goes in and adjusts that pension number away from your discount rate to FTSE. FTSE's at about 3% right now. Discount rates are, I don't know, 6.5%, 7%, you know, depending on, most people set it to CalPERS, but, you know, let's just say 7%, because that's about what it is in Texas. And that means that what we're factoring into our methodology under that 10% or higher weight is much higher than what your actuarial report is. So if you talk to a lot of pension people, you know, whatever, firefighters or police officers, will say, well, we're 88% funded, we're whatever the case may be funded. And that's not actually what goes into the rating, because Moody's adjusts it to a much lower high corporate bond yield index, basically. So, does that answer your question? Okay. Yeah?
How do you make that adjustment without knowing the duration of liabilities or you know, active retiree plans, things like that?
Yeah, so we take the measurement date, let's just say it's 1231 because a lot of them are. And it's whatever FTSE was on that day, recast the liability at a 20-year AM?
The duration is actually, I think we estimated at 12 to 13 years. I think that's a common, a common duration.
So it's the same regardless of whether it's a new plan with new retirees or whether you've got.
We repackage the unfunded liabilities using that FTSE, that high-grade corporate bond index rate as the discount rate. That's our biggest adjustment. That's our most potent adjustment. So it really is just repackaging those unfunded liabilities, looking at the. Oh, sorry. Go ahead.
But what I'm trying to say is how you make that adjustment will be very different for retirees and for actives.
Yeah, we just take the liability as it's reported, whatever the actuarial has decided that liability is, and apply the FTSE to that. So, and it's not even police, fire, municipal, it's all of the pension funds recast and set to a new Moody's adjusted net pension liability. Does that answer your question? It doesn't look like it does.
Yeah, I mean, I'm speaking as an actuary, and I know that.
Oh, you need Tom.
Such an adjustment can be extremely different based on demographics.
Yeah, so I think it's because it's what we have from what is reported by the time it gets into the pension plans report. It is the best. It's not considered a gold standard. It's considered the best comparability because we're comparing across 12,000 governments. We have to go with the best possible way to get an equalized high yield corporate bond index to adjust. But admittedly, it is very low, and we know, and right now especially, and we know it is. So sometimes, it's only an annual adjustment. Sometimes you'll see wide ranges. A couple of years ago, December was a horrible month, right? And so we knew that was going to change over time. So our actuarial will recast numbers for what kind of equalizes it out. We had considered doing a 3-year average to make it a little more smoothed. Originally it was the city index, right? Was our original one before we went to FTSE?
That's the same. It's the same thing.
Oh, okay.
Yeah.
Well, there you go. See, I'm not an actuarial or pension expert. But anyway, and so once we did that, once we kind of decided on 1 year, we know that the measurement time is something that we have to take into consideration when we have big swings in those numbers that we're going to talk about, which are adjusted net pension liability, fixed costs. It's not that's not the only thing we look at, but it is one of the factors and probably the most controversial because we adjust.
The net bottom line is you use one basic adjustment factor regardless of demographics, and assume everyone's kind of the same on that.
That's correct.
It makes it comparable. That's what that adjustment is for, so we can be comparable across all the discount rates and all the funds. Yeah. No, yeah.
It's using the plan assumptions.
Uh-huh.
So pension bond obligations, if a city takes a pension bond obligation to pay down unfunded liability, does it hurt their Moody's rating, make it neutral, or make it better? Restate the question.
Okay. What happens with POBs? Are they considered a credit positive, neutral, or negative? So pension obligation bonds, from a credit perspective, to deal with a liability vary. I think the person prior to us was talking about the Kansas situation. Those POBs were put in place to reduce the contributions or to help fill a gap. That would be considered a negative, right? You're basically just kicking the can down the line. In Houston's case, they issued $1 billion in POBs, and that was ultimately a positive because it allowed for negotiation of reduction of or adjustments, reform to the pension plan. It was part of a negotiation tool. It was also issued during a time where interest rates were, really advantageous on the POBs. And so, for the most part, that one would be considered positive. But in most cases, pension obligation bonds are considered neutral because, of course, there's some risk, especially in today's time, of whether or not the fund will earn as much as the cost of the increase to the asset from the pension obligation bond. So generally they're neutral, but they can be negative or positive. Any other things you wanted to know besides actuarial things? Okay. So we probably went over a couple things I was going to cover, but I'll just kind of, make sure I give an overview on a couple things. We talked about the coverage. This page is covered. Good job. Okay, so we have a adjusted net pension liability, which we talked about. And as you can imagine, from 2013 to 2021, the amount of, let me just switch pages here so I'll give you the numbers correctly. The amount of pension liability to operating revenues has increased quite a bit. So I went back before this discussion here today and took a look at what the trends were. So, once we adjust the net pension liability, we then measure it against the cities or counties or school districts' full value, meaning their tax base, and then we also measure it against their operating revenue. So we understand what's going on from a debt perspective or a leverage perspective. In 2011, the amount of liability to the operating revenue was about 0.8%. In 2021, it went to 1.8%. Part of that is because discount rates have been highly reduced over that time period. When the actuarial reports first started coming out in the GASB 34 statements for governments, they varied widely from year to year. I remember meeting with Travis County, and I think one year it was, let's just say, $50 million in liability, and then the next year it was $130 million in liability. So until some standards in that reporting came into place, things just varied considerably during that time period. And it took, probably 3 to 5 years till we got something that Moody's is making observations. We're not giving advice, we're making observations and then decisions on the credit opinion based on those observations. And so, it took some time past the reporting for us to be able to calculate those and make them meaningful in your credit, in the city's credit rating. Let me see. Texas schools are about 0.3 times, and in 2011, and then they went to 1 time. So the schools are actually having, less pressure on the credits than some of the cities and counties, and it's totally different. And I speak in terms of, the statewide shared benefits type of plans, not the city specific for Houston and Austin and San Antonio, Fort Worth, and Dallas. Okay, so that's just kind of a broad idea of what's happening or what the landscape is in Texas around the adjusted net pension liability as a percent of the operating revenue. I think generally speaking, Texas cities are around, let me see what I write here, 1.5 to 4% of the full value is the adjusted net pension liability, which is about 1.6 to 2 times. If you look at it from a national perspective, you can go as high as 8% on how much of the full value is the adjusted net pension liability, or 3 times the operating revenue. So there's certainly pressure in other areas of the country. It's kind of one of those thank your lucky stars you're in Texas comments to make. So the adjusted net pension liability is something that we use in our methodology to figure out what kind of leverage is on both the tax base and the operating revenue. The other thing we calculate in our methodology is the fixed cost. So how much of the operating revenue goes to things the city cannot budget adjust for, right? So when we do a fixed cost calculation in our cities and counties as part of our 10%, we're looking at the annual debt service, the pension contribution, and the OPEB contribution, and what percent of that does the city have to budget to pay for before they ever start to decide if the parks are going to be mowed every 2 weeks or every week, right? So that's kind of what kind of governance challenges cities have around being able to afford their pensions. So I wrote down some numbers there. We calculate this figure two ways, we calculate it one way with the three things I told you about, but then we measure it against the revenues at the actual contribution rate as well as something called the tread water rate. And very simply, the tread water rate is how much would you have to contribute to not grow your liability. It's not like we had a great naming convention there. It's pretty straightforward. We calculate that with the actual reported amounts of the service costs plus the interest on the unfunded liability. That's kind of how we figure what the tread water rate is going to be, and then we subtract it to get a gap and find out if you're contributing at tread water or not. Any questions on that? Got some figures for you. Okay, because that's what Moody's does. We talk about figures a lot. So if you were to calculate fixed costs, like how much are cities really paying for pensions, debt, and OPEB? In Texas, we're at about 16 to 24% as the contributed rate to the percent of revenue is about 16 to 24%. Nationwide, it's 11 to 25%. Counties are a little different because they're so large. You're looking at about 10 to 40%, but most are under 15 on that factor. And then if everybody was contributing at tread water, it'd be 13 to 25% for Texas cities. And the nation's about the same. So, okay. Let's see, we talked about that. Okay, K12. So I don't know if anybody's here from the school pension. No school pension, so you don't care about that. Yay. And then I'm just going to hand it over to Grayson in a second, except for to weigh in a little bit on Texas, the legislator, and what we call the small U state, because we're a right-to-work state. We have a lot of flexibility as a state to adjust benefits and then therefore adjust the liabilities, issue pension obligation bonds, whatever the case may be. And I think that what we've observed at Moody's is that we have the support of the legislator, the Supreme Court, to make adjustments to the pension obligations, which is a positive impact on the overall credit score when the liability drops. And I think that we've written about it quite a bit. That outsized ability or a positive in our case in Texas has really served well, and our pension funds are, our statewide pension funds are very well funded. We really haven't had any downgrades for pensions except for in our large single employer major cities, which some have gone through reform, most are long-term reforms, but for the most part, Texas is, looking pretty good from a credit perspective on the pension landscape. I'm going to pass it over to Grayson to give a little more detail, and then we'll take questions at the end if there's time. Thanks.
Thanks, Gera, and thanks, Art, for having us. Okay, so my name is Grayson Nichols, and I am a local government analyst with Moody's. I've been with the rating agency for about 13 years, and I've covered a wide variety of credits during my time at Moody's. Have seen some pension reform, have seen some pension downgrades. I'm the lead analyst for the city of Austin, who just went through a quiet reform in the last legislative session. The year prior, we did a one-notch downgrade because of mainly due to pensions. But today, I want to cover three topics that we are looking at as a rating agency at this point in time. And the first is on recent pension funding improvements, the second on the market volatility risks, and then finally the pension funding effects that inflation and rising interest rates have. I imagine you've heard a lot about these topics the last couple days, so I'll give you the rating agency perspective on those. So let's start with the recent funding improvements. So clearly 2021 was an exceptional year when it comes to investment returns for U.S. public pension systems. And the returns posted in 2021, if they weren't the best, they were very, very close to some of the best annual returns. So, and while often the long-term trends are the focus for pension systems due to their relatively long investment horizons, the boost in assets really helped out on, it did really significant improvements to funding. So, and those improvements are clearly a credit positive for state and local government credit quality, because not only did their balance sheet liabilities fall, but the pace of the cost increases that were poised to happen also dropped. So at the end of calendar year 2020, the Federal Reserve sized state and local government unfunded pension liabilities right around $4 trillion. At the end of calendar year 2021, the same value published by the Fed actually dropped to $3.6 trillion. So clearly an improvement there. And to provide a Texas-based example, the Teachers Retirement System of Texas posted investment returns of nearly 25% for 2021. Its reported unfunded liabilities dropped from $53.6 billion all the way down to $25.5 billion. And that multi-billion-dollar drop is illustrated on the left-hand side of this slide as the green bars. And as Gera mentioned, our Moody's adjusted net pension liability using that high-grade corporate bond index as the discount rate are the blue bars, and it's a huge difference. And the difference is a discount rate of 7.25 versus 2.75 at that measurement date, that spot rate. So, but that is an approach that actually closely aligns with the Federal Reserve and how they calculate these liabilities. So while the liability figures are higher for us, they still improve because of the very, very strong asset performance. So TRS, Moody's adjusted net pension liability went from $226 billion in 2020 down to $200 billion. Now, turning to the budget or the income statement perspective, the contributions that Texas and other participating governments, such as school districts sending money to TRS, are going to go much further this year in terms of paying down reported unfunded liabilities. So, as Gera mentioned, we gauge government contribution strengths versus our tread water indicator. GASB 67 and 68 really opened up the ability to find that tread water. Are you keeping your head right where it was, or are you overpaying, or are you paying down some of that liability? So the chart on the right-hand side of the slide illustrates how the tread water indicator in 2022 is falling pretty dramatically because of those huge investment returns. So the contributions that the governments are sending into, or the school districts are sending into TRS, are the gray bars on the right-hand side, are actually going to be above the tread water indicator, meaning that based on the plan's assumptions, because again, it's based on if all assumptions are hit, those contributions will actually be going towards a pay down of the portion of unfunded liabilities. So to sum it up, the huge 2021 investment returns have produced materially improved pension funding figures for many governments, both from the long-term liability perspective, but also from a near-term cost perspective. I know, right now, what the markets have been doing, could make that change a little bit, but the returns last year were so strong and really afforded a much better funding picture for U.S. public pension systems. Now, the second kind of topic I wanted to talk about was just market volatility risks. So I just talked about how strong investment returns were in 2021, but the types of pension fund investments that drove those returns, such as public and private equities, are also the types of assets that carry the highest risk of volatility, especially in comparison to assets such as high-grade fixed income securities, which of course carry lower return expectations. So the chart on the left hand of this slide illustrates the magnitude of state and local government pension assets relative to the U.S. economy or the U.S. gross domestic product, so GDP. The green portion is equities, while the blue portion is just the catch-all of everything else in terms of assets. So very significant. On the right-hand side of this slide is a chart that illustrates the challenge that low interest rates pose to pension systems as investors. So it depicts a portfolio composition estimated to produce a 7% return target back in 1991. There's a 15-year increment, so 1991, 2006, and 2021. And as interest rates have fallen, that portfolio composition has had to shift to public equity and alternatives such as private equity and real estate, really to hit that 7% target. And to come up with that, we're using the JP Morgan capital assumptions, is using that efficient frontier from those dates. So again, the scale of public pension systems relative to our U.S. economy, but also to a sponsoring government's budget, is now at or really near historical highs. So that is to be expected, given that U.S. public pension systems are increasingly retiree heavy, with the baby boomer generation now or beginning to retire. But on the other hand, that means pension investment losses, should they occur, like what we're seeing right now with the market, they can be quite large in relation to a government's budget. And those asset losses become new unfunded liabilities and have to be amortized. So definitely risk there. And the assets are so heavily allocated to more volatile asset classes now, that meaning there's a chance, although that's not our baseline expectation to happen, the risk of suffering losses via a market downturn are very material, because the size of the assets that these pension plans have amassed are much, much larger than a government's budget. So, and on the heels of these really strong investment returns in 2021, we've really seen some pension systems take the opportunity afforded by the boost in assets to lower their risk, namely by dropping their assumed rate of return. So, normally that would cause an immediate increase in government contribution requirements, but because of the huge investment gains, we really expect the hit to government budgets to be fairly minimal. I think the best example and the largest example clearly is CalPERS, who went from a 7% discount rate down to a 6.8% discount rate because of the asset returns that they saw in the year prior. Any questions about that topic? Okay. Now moving to the final topic that I wanted to talk about today, and it's certainly clearly at the forefront these days, and that's, of course, inflation. Retirees that receive pensions from state and local governments often receive a formulaic COLA, or cost of living adjustment. And last year alone, in 2021, the Social Security, they awarded a COLA that was greater than 5%. And to illustrate how inflation can affect pension payouts, on the left-hand side of the slide, you'll see an example from the state of Illinois where retiree COLAs are actually going to be approaching their formulaic ceilings because they're linked to the consumer price index. And since that's going so crazy, that translates into higher pension payouts to retirees, and thus costs the sponsoring government more money and more fixed costs, like Gera was talking about. On the right-hand part of the slide, we've depicted something that we've started observing, and that is a growing political momentum to revisit the topic of retiree COLAs. So COLAs for some retirement systems represent a material portion of liabilities. And because of that, they've been a very popular part of pension reform. It's one of the first things, and it actually has a very potent change if you were to change COLAs. So, government seeking to lower their liability sometimes look to COLAs or cut COLAs. So for example, the state of New Jersey essentially suspended COLAs nearly a decade ago to save on liabilities. And then another example is the statewide teacher pension system in Ohio. I'm using them as an example because of something recently that just happened. They're depicted on the right-hand part of this slide. Given the pressure, or they suspended their COLA back in 2017, but given the pressure of inflation, that system's board of trustees earlier this year was examining the potential liability increase if they were to fully reinstate their COLA, just because of the pressures that are mounting because of inflation. So we've quantified that on a reported basis as well as our Moody's adjusted basis, and you can see on the far right, if you were to if you can compare 2021 with the COLA and without the COLA increase, it has a very significant impact. It basically takes you back to 2020 levels after having such strong asset returns in 2021. So very, very material increase in liabilities in terms of if COLAs were to be reinstated after they have been cut. So in the case of the state of Texas, the state recently granted COLAs to TRS retirees, for example, but they did so through a one-time ad hoc appropriation, just a check going out to retirees, really to avoid generating new unfunded liabilities. So there's just that example of how inflation can really impact can impact pension systems. But as Gera mentioned, pensions are just one of many aspects of our credit ratings. We're not just actuaries or just pension analysts, and that's what drives ratings. It has driven ratings in the last decade because of the spike of unfunded liabilities have gotten to such a magnitude that might not be characteristic of a AA or a AAA rating, but again, they're just one of many factors, but we believe they can bleed into our other factors. So for example, finances. We talked about this tread water indicator. If a city or a county or a school district is not paying, at the tread water level, which is, again, the amount necessary to keep the unfunded liability from growing under reported assumptions, we believe that's masking a structural imbalance, right? That's money that's not being paid. So even though you're having, let's say you have a tread water gap, or the difference between what you pay and what under reported assumptions would keep that liability the same, let's say it's $1 million. If you were to have a break-even budget, we would say you have a structural imbalance of actually $1 million because you're not paying that tread water indicator. So that's where it impacts finances. And if you're masking this, the structural imbalance, that could play into our ratings. Also, when it comes to debt, what we've seen in the few very large bankruptcy cases is that debt and pensions are viewed the same in the bankruptcy court. So we view it the same. And if you can't pay your debt, you likely can't pay your pensions, or vice versa. So another thing that it bleeds into, another factor that pensions bleeds into, is management. Is management being proactive about their pensions? Are they being reactive? Are they kicking the can down the road? Those are the things that the pension feelers can get into many of our different factors, and therefore can have impact to ratings. But that's everything that I wanted to discuss on the topics. But wanted to open up the floor for more questions. Anything that we've gone over? Anything else? Yes, sir.
I wanted to understand the impact of how giving a COLA affects the rating. Meaning, if you have a COLA that's like a flat percentage, infinite given, it's given on an ad hoc basis where it does affect the annuitant pay, the annuity that they're receiving. And then you mentioned the third check, which I understood.
The third check, what was that?
You talked about the third check just giving, so that doesn't cause.
Oh, just giving.
Increase to the annuity.
Correct.
What about like a one-time COLA that's evaluated on a yearly basis?
You know, that would just have to, that would be evaluated. We would take what was reported. You know, if let's say a system were to give a one-time 2% going forward, that would just be baked into the actuarial report, which we would unpack at a different discount rate. Just because you give a COLA does not necessarily mean it's going to have an immediate rating impact to your city or county. It would be more broad. We'd have to take a look at it, see how big of an impact. You know, is it a 10% COLA? You know, with the Ohio teachers, you know, that would have a material impact, but don't necessarily believe that would have necessarily rating change. We're not upgrading everything in Ohio because of the strong returns in 2021, and they might now go backwards if they were to reinstate the COLA that they suspended in 2017. We try to look more at just trends, you know, try to look through different cycles and trends and things like that.
I do think something that will be interesting around the COLAs is those that are set to a percentage of inflation. You know, what's going to happen in the next year and a half as it's expected with the Fed, because, you know, we've been in such this low rate for so long and 2.5% kind of growth. I think for a couple of years we're going to see a higher growth, and I'll be interested to see what happens there, but, you know, yet to be reported. Especially with some of the cost corridor and cost measure controls for the expenditure from cities and pension funds. It'll be interesting to see how that's handled, and maybe they'll pause like Ohio Teacher Fund. I'm not sure, but it'll be interesting to observe going forward.
And as the Fed raises interest rates to fight inflation, that will actually have a positive impact to our Moody's adjusted net pension liability, because that FTSE pension index will actually increase, and so our discount rate will increase. Of course, we can't tell by how much. You know, it might go up 25, 50 basis points over this, you know, next few years as the Fed increases rates, but it'd look more favorably in comparison to like a 3% or a 2.75% that the FTSE was, you know, at the end of this last year. So anything is a little bit better in terms of our Moody's adjusted net pension liability. So that will, now the other side of the coin is how will markets react to the Fed interest rate hikes? You know, so it might have a kind of a seesaw effect between the you know, on the balance sheet, but wanted to mention that as well, that our Moody's adjusted net pension liability, forward-looking with rising interest rates, will improve across, you know, and will improve unfunded liabilities, all things else constant, here over the next few years, likely.
Grayson, you talked a lot about the asset performance, and I answered a question about assets via POBs. Do you want to talk a little bit about the asset shock indicator? It's not part of the 10%, but it is something we kind of keep an eye on now and again, and
yeah,
that
no,
kind
sure.
of helps this group understand.
At Moody's, we come up with different, you know, we have our Moody's adjusted net pension liability. We have this tread water figure. Another thing that we look at is called the pension asset shock indicator. I touched on it briefly on one of my hot topics, and that was just the market volatility risk. Given that the very, very mature pension plans have, you know, amassed such large assets in comparison to the sponsoring government, our pension asset shock indicator is using the assumed rate of return, using the JP Morgan capital market assumptions as an input to that. It's basically finding what annual percent chance there is for a market downturn that equates to pension losses that equate to 25% of a government's budget. So for someone like Houston that has amassed very, very large pension assets in comparison to the city's budget, their pension asset shock indicator is much higher than, let's say, a smaller local government that doesn't have as a mature pension plan. So, based on capital market assumptions, that's basically saying the city of Houston has a 20% chance of any given year they could lose pension assets that would equate to a quarter of their budget. We use a quarter of their budget or just for the pension asset shock indicator as kind of this bogey, because if you really think about it, a quarter of your budget, that's significant, and that would be very hard to make back up, especially when you are doing so many other things as a city. Just having to think about dedicating almost a quarter of your budget just to shore up. I know that wouldn't happen, but we're just trying to look at the magnitude of things, and that's really what our pension asset shock indicator tries to do. But again, the cities and counties with the most to lose are going to have the highest pension shock, the pension asset shock indicator. So.
I think everybody's still awake, which is good for one of our discussions. Oh, we can't see. There's a big light, so just go ahead if you have a question. Sorry.
Grayson, Gera.
Hey, Dwight.
Oh.
Quick question. The previous speaker spoke about the importance of meeting your annual required contribution. There's some concept you talk about that. I love to speak, and you talk about spread water and all that stuff. Can you speak in terms of quality management, evaluation, and credit rating, perspective about meeting your annual required contribution?
You want me to take that? Okay. Thanks, Dwight. There's a Moody's alum. So quality of management, I guess I'd start with the challenge is not all governments have the ability to contribute at a tread water, right? There's statutorial contribution rates, there's multiplayer employer cost sharing plans, which it would be silly to contribute over your rate into pools like that. So not everybody has the ability to. We have seen in very rare cases trusts for those that wanted to contribute more. They just form their own trust for additional contributions. That's considered a positive. But in most cases, it's really just looking at the bottom line of whether you're structurally balanced. Is the annual cost being met with the annual revenues, which is certainly a huge part of any kind of financial analysis. And I think where the governments could contribute to the rate of tread water, you would expect that they would be, especially, by now. But I don't know that I don't think it would cause a rating change necessarily, but it might just be a consideration of some of the harder political will questions we have, especially in Texas, with more of a limitation than we've historically had on the ability to raise revenues post Senate Bill 2. So, it kind of depends on what kind of ability they have and then their will to do so. Whether or not governance itself or the management team or administration teams are being evaluated on that factor. There's a question in the back. I can see you in the middle. Yeah. Sorry.
When you're doing the stress testing and looking at ratings, how wide of a structure are you looking at? You look at something like 2007, 2009 dislocation and say what sort of impact that would have on ratings, and how large of an impact would that have on city ratings?
Now that's the question was, what kind of stress testing do we do to assets, and what kind of impact would it have on ratings? Correct. So when it comes to stress testing pensions, we use that pension asset shock indicator that I just talked about. We don't necessarily just take a look at the assets and say, what happens if we do, if it goes down 25%, or what happens if it goes down 20%? Again, we try to rate through cycles, right? So at Moody's, even with the pandemic, we had very few rating changes, and that's because we try to rate through cycles. We look through the cycle. If we were to have believed that things were going to continually go downhill, we would then, of course, make rating changes. I think the same thing goes for pensions. Just because of last year, we're not across the board upgrading a bunch of credits because their unfunded liabilities dropped dramatically. Same thing goes for the downside. We try to look through the cycle, look at the trend, but to stress testing, that's really what we have the pension asset shock indicator. If there was when going to a rating committee on an individual credit, if they were to have a really high pension asset shock indicator, we might take that into consideration as a qualitative adjustment to the rating. Like, hey, they have a huge chance that at any given point in time, if the market turns, that could have a big impact to their unfunded liabilities and overall leverage profile. That's when it could impact the ratings. But to answer your question directly, we try to rate through cycles, and if we're seeing a prolonged cycle of softened market assets, the value of assets, that's when we might see rating downgrades. Some of the biggest revisions that we had in the state of Texas, they were multi-notches. Dallas at one point was a AA1 and is currently an A1.
It was a AAA before
It was a
we were
AAA
there,
before
yeah.
that. Houston was a AA2 and went to AA3. Austin was a AAA, went to AA1. When we see these pension pressures, it's usually met with some type of reform, whether it's POBs or a new benefit tier opening up that can help, suppress unfunded liabilities from growing in the long term, that really help keep the ratings at a not having major movement just because of pensions. I hope that answers your question. Great.
I think, are you ready for it? I think some of the stress tests is around, in Texas in particular, we've been growing for so long, and I think some of the stress is not so much, what the returns will do, but what happens when we stop growing at that rate and we're stuck with the 3.5% revenue and the liability continues to grow as, the aging population that benefits from the pensions starts to take advantage of that. I think that's where a lot of the stress is from a credit risk perspective.